Hello, this is Kalman Andrassy, and today we're going to be talking about economic indicators, which is all about trying to make predictions about the way that the economy is going to be playing out based on a number of different factors. So let's go ahead and dive into that and see what allows us to make predictions about the way things are going to ultimately play out in the near future based on what we know about the conditions in the economy. So the first concept that needs to be addressed is the Phillips curve. And the long and the short of it is that as the unemployment rate increases, the inflation rate tends to decrease, and vice versa. As the unemployment rate decreases, the inflation rate tends to increase. And that is because I think it makes a lot of sense in the sense that, you have high amounts of employment, you have a lot of employees working to put out a product. It increases the overall cost of that product. Prices are going to increase. You have fewer people to work on the product. With a higher unemployment rate, the prices are likely going to be dropping, right? So that is one thing to kind of bear in mind. If you're seeing a high unemployment rate, very rarely is that accompanied by a higher inflation rate. Now, that is not something that is 100% set in stone, however, and in times of really significant economic turmoil, you might actually see both inflation and unemployment increase pretty significantly. So it's a really bad sign if you have both a high unemployment and a high inflation rate without the inverse relationship happening. Next up, we have the Consumer Confidence Index, which is all about how optimistic individuals that are buying goods and services in the market, how they feel about the overall state of the economy. And it's an index. It's a bunch of different questions that are asked about economic conditions, employment, expectations for the economy in the coming period, a person's personal financial status, and things like that. And it's been found to be directly correlated, a positive correlation, with consumer spending. So people who are more confident about spending are going to be more likely to make major purchases, and individuals who are less confident are probably going to be less likely to make major purchases. They're going to spend less money, and that's going to be a overall negative for production and for economic growth. And then kind of the other side of the same coin of this is the Business Confidence Index, which looks at business firms and their confidence in the market. And that's based on things like hiring intentions, plans for the business in terms of expansion and things like that, hiring and whatnot. And then, of course, expectations for any future business and economic performance, where they think the economy is going to be in the next given period. And of course, that is going to be correlated with economic contractions and recessions. If a business is going to be less confident about producing, it means that for its part, it's not going to be as productive in the market, and it's going to lead to a potential contraction in the business operations and production of that individual organization. And then, of course, collectively, if a lot of businesses follow that trend, you do tend to see the beginnings of a recession potentially, or at least some sort of a contractionary period. Okay. Next up, we have the Consumer Price Index, and I think we briefly talked about this a little bit earlier, but this is that basket of consumer goods and services that the representative individual in any given economy is expected to utilize and purchase. So it includes things like housing, the cost of popular foods, medical care, and transportation and things like that. And of course, whatever those foods are changes from period to period. Back in the day, perhaps gelatinated meats and things like that would have been prominently featured in the consumer price index, and probably not so much today. But you'd probably expect to see things like some fast food restaurants and things in there. You'd probably see a lot of chicken and perhaps beef, since Americans tend to eat those two types of meat above all others. And then some of the staples and whatnot. You probably see rice and potatoes on there, and perhaps different pasta dishes and things, or not necessarily dishes, but pasta itself, I should say, on that list. And again, that can potentially change from year to year or from generation to generation. And of course, the way you calculate it is, you look at the rate of inflation, and that is reflected by whatever the current consumer price index value is, minus the base, or the comparison year, the previous year, and you divide that all by that previous base comparison year, and then you multiply that by 100 to get a percentage of how much inflation is expected to increase in total for that particular period. Now that being said, it's not always going to be a perfect correlation or a perfect reflection of the entirety of the economy. Sometimes the CPI doesn't include certain goods or services that could potentially be a lot more volatile and a lot more subject to change from one period to another period. There is something called the core consumer price index that tries to exclude particularly volatile items, even though I think it would be fair to include those given their prominence in our life. For example, energy. If you're paying more for electricity in a year, that is definitely an increase in the overall price of what you're paying, not just for running your own home, but if you're a business firm or anything like that, you're hoping to utilize goods and services. It does require energy, which if there's an increase in the overall price of that, it is going to be an increased monetary burden on you. So use the core CPI at your own discretion. But certainly, those kinds of items can be significantly different from one period to another in terms of their prices. So, sometimes it doesn't make sense to include those just in terms of trying to understand in general how inflation is affecting people in the market. And then, of course, the reverse side of that is the producer price index, calculated much the same way as the CPI, but this is for business firms, right? It looks at the average changes in sales prices for producers of goods and services, and it looks at multiple stages along the production process. It begins with your input goods, your commodities that are the raw materials used to produce your goods and services. Then you have intermediate goods that are partially finished or processed. And then, of course, at the end, you have your final demand goods, those things that actually go out and are ready for the public to consume. Okay. In addition to that, we've got a lot of individual markets that also tend to give us a pretty good idea of where the economy is going. The housing market being one of those. So there are lots and lots of different housing market indicators. There are lots of indices that are out there. You've got the Case-Shiller index. You've got the housing affordability index. But all these different types of indices tend to examine things like, new housing starts, the construction of new homes. Requests for building permits to, again, to either build a house or to expand upon a house. Existing home sales, so in a lot of markets, Los Angeles Southwest colleges in California, there are very significant restrictions on new housing construction, so the vast majority of houses on the market are existing homes. So looking at those as a means of understanding where the housing market is going. Of course, new home sales, mortgage rates. How much are people paying to pay off their houses? Essentially, inventory levels. Is there a backlog? Are houses just not getting sold? Are there a lot of houses sitting unoccupied that aren't being sold? And then, of course, foreclosure rates. How many people are defaulting and unable to pay off their mortgages? These are all things that are, important to look at to see, how are things playing out as far as housing is concerned. Okay. Then, of course, there's the stock market. That's another very important element in understanding the economy, because ultimately the stock market is going to be a reflection of the gross domestic product, since it is about the publicly traded businesses and producers that again are going to be traded on the stock market. And of course, there are a lot of different things to kind of keep in mind about the stock market, and a lot of different theories that go into understanding the stock market. The efficient market hypothesis is essentially that there's a sufficient amount of information available to us that for the most part the valuation of stocks is going to reflect all of those different things, making it somewhat difficult to engage in different types of analysis to make predictions about where the stock market is going to go or where the price of an individual stock is likely to go. And the general idea there being that investing in one stock or another is ultimately going to be relatively random in its approach. But again, the idea of the stock market is that you're selling partial ownership in a business so that you get returns for the activities that business engages in, and that you can share your ownership, hopefully, at a positive return. And so, understanding the stock market and seeing where it's going, seeing if it's more or less continuing to increase or if it's starting to show signs of reduced prices, that could be a very important indication of the way the market overall is going to go. And of course, there are some, like I said, a bunch of assumptions. No opportunities for arbitrage, which is basically the idea that you buy up a stock and then can simultaneously sell it, so that it kind of you always maximize the ability to sell at a higher price, because the increase in purchases is going to lead to a higher price in general. And there's a lot of things to kind of look out for. Ultimately, the stock market values are going to give us a pretty good idea of whether or not there's the likelihood for some sort of a crisis to happen, or there are bubbles or overvaluation of certain industries and things like that. The stock market tends to be pretty good at providing that kind of information. Now, what I didn't necessarily include in this slide is that big data is a kind of an emerging field in tech, where you're taking a significant amount of data kind of from aggregated internet activity and things like that, and you use that to make make a more precise analysis of the way that certain elements of, in this case, the economy might be playing out. And that is something that I think is going to be shifting and changing a little bit in the future here, and that's going to shift and change how we examine the strength of the economy over time as well. To put things in perspective, you know, if you were able to find certain trends in the things that people were looking at online and the types of activities that they engage in, that could also potentially be indicative of the way that the economy is going to be playing out in any given upcoming period. So expect in the future for there to be a lot more technical data like that being put forward as yet another means of getting more precise analysis of and trying to make predictions on how the economy is going to either be generally expanding or retracting, and potentially getting us more precise numbers than we could get just from things like the CPI and the PPI and the housing and stock market indices and things like that. Okay, so do expect that to be kind of revolutionized in the next couple of decades here. And, you know, new and interesting theories popping up, utilizing big data to try to figure out and make predictions about the economy moving forward.